Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone. Welcome to the India Market Outlook podcast. My name is Vinay Joseph and I'm the host of this podcast. Now we have just released our August India Market Outlook titled Positioning for a Consolidation. Before I delve into the asset class view, a quick summary of how H2 2025 has started. Now Indian equities have underperformed since the start of H2 2025 as risk sentiment has soared on higher than expected US trade tariffs, muted Q1 earnings delivery, and resumption of foreign investor outflows. If we look at performance, since the start of H2 2025, the benchmark Nifty index is down around 3.4%, underperforming its major global peers. MSCI Asia ex-Japan, which is up around 5.6%, and MSCI Developed World, which is up around 4%. Broader markets have trailed large cap equities, with the Nifty index, mid-cap index, and the Nifty small cap index down 5% and 7% respectively. Looking at other asset classes, the 10-year IGB yield rose 7 bips to 6.4%, while the INR has fallen to new all-time lows, dropping by 2.3% against the USD. Now, given this backdrop, how do we see the asset class performance going ahead? In the near term, market volatility is likely to stay elevated as domestic investors adjust to the higher than expected US trade tariffs, which kicked in on August 7th and further 50% which will kick in on August 27th, and what would be its likely impact on both growth and sentiment. We remain still overweight on equities and remain buyers on dip, given four factors: improving macro fundamentals, an accommodative fiscal and monetary policy both at home, earnings recovery as shown in the delivery of the current Q1 earnings, and better valuations, both relative to bonds if we look at earnings yield and bond yields, which points to equities doing better, and also to major peers, given our sharp underperformance and stable earnings delivery in the coming few quarters. On bonds, we remain neutral as we expect the yield curve to steepen with bulk of the rate cuts behind us. Gold and multi-asset strategies remain key diversifiers, which would help to mitigate near-term volatility. Now moving to sub-asset class views, within equity, the risk-reward is more balanced, and hence we prefer a diversified equity allocation. But there are selective opportunities. We like mid-cap equities given its strong earnings delivery and reasonable valuations. And within sectors, we prefer a barbell sector strategy, with an overweight on domestic cyclicals, predominantly financials and consumer discretionary, which is balanced by a defensive overlay through an overweight on healthcare. Moving to bonds, given our improved risk-reward environment for medium maturity bonds and high-quality corporate bonds, those are our preferred allocation. That's all on our asset class view. If you need a copy of our report, please reach out to your relationship manager, or you can visit our website sc.com/in or log in SC Invest. Thank you.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered relationship manager or visit www.sc.com/in.